Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Gosh, we've got a show today that's packed up with great educational information, as always. We're going to kick it off with, this is very interesting. How did China's trade surplus hit $1.1 trillion this year? That was not supposed to happen, and it did. Finally, some data on the labor market. Also, to the inflation report, shows great progress, going to be trusted. We're going to combine these two together because we finally have data coming out from the government that we can use. But can it be trusted at this point in time? That's the important part. And also, too, you want to become a millionaire? Well, invest in your 401k. That's happening a lot. We'll explain how to do that as well. And then with us is Chase. And Chase, what companies are we going over today?
Yeah, so companies we're going to look a closer look at today include Oxford Industries. You might not be familiar with them, but they are the owners of Tommy Bahama. And then I'm not familiar with this brand, but Lilly Pulitzer is the other brand. So
that sounds like a female brand.
Yeah, it appears to be that. But again, Tommy Bahama was the draw from us because I know we both kind of like Tommy Bahama.
I got a lot of other shirts.
Also, too, we're going to talk about Exxon Energy, Vail Resorts, and Costco. So excited to break down the fundamentals, give you an idea if we think those are buys, sells, or holds based off the fundamentals we see here on air.
All right, well, let's dive into finally some data on the labor market. With a government shutdown, a lot of data for the labor market was delayed. We finally got employment figures for October and November, and they were interesting, to say the least, to start. The October numbers look horrific considering payrolls declined by 105,000 in the month. While this sounds troubling, it's important to remember all of those government workers on severance were still counted as employed until the severance ended. And we talked about this 5 months ago when it first happened. I said, wait until October. Yeah. It came, and it happened as we said it would.
Yeah, I mean, it was a ticking time bomb that we knew was coming. And, you know, when it came about, it was actually larger than I thought it was going to be, honestly. I mean, there was a decline in government payrolls of 162,000 in the month of October. And again, I want to go back to that headline number, right? 105,000 was the decline, but government was down 162,000. So, I mean, it really would have been positive outside of the outsized decline in government payrolls. And if you do look at losses in government payrolls, they did continue in the month of November, but at a much slower rate as they tallied 6,000 in the month. Since reaching a peak in January, government employment has seen a decline of 271,000 jobs. And looking at November payrolls, they did increase by 64,000. But again, it's a very interesting situation, right? It's like, well, it's not as bad, but well, maybe it's not as good because healthcare continues to do most of the heavy lifting as a sector accounted for more than 70% of the total net increase and added 46,000 jobs. And I mean, healthcare, sometimes I call it, actually Sarah Eisen from CNBC, she called it government adjacent because they get so much government money in the healthcare space. Okay. So it is kind of
right
money that's funneled from the government. So sometimes it's like, well, I mean, things are going okay, but then there's some other question marks. It's a very interesting labor market, to say the least, right now.
And I was kind of wondering when I first saw that, like, so what is bad about the healthcare? Because a lot of healthcare does come from, you know, the insurance companies, and some people have to pay some themselves and so forth. But you're right, there is some government assistance, I guess. Well, Medicare, I guess. Yeah. So that could be the situation there. And I do remember the 162,000. I believe we said, correct me if you remember differently, back about 4 or 5 months ago, it was estimated about 120,000.
Yeah, that does sound about right. So, I mean, it was large. And also, too, within that government, there is the state and local. So, I mean, it didn't really break down essentially how much was purely federal government. But I do think it was still above at least what I was expecting.
Yeah. Also, construction was strong in the month as the sector did add about 28,000 jobs, but many other areas saw little change, and transportation and warehousing was weak as payrolls declined by 18,000 in those two areas. Another concern in the report was the unemployment rate did tick up to 4.6%, which is above the 4.4% level in September and marked the highest reading since September of 2021. And Chase, I'm looking forward to hear a little bit. Is that by chance because more people came in the labor market, or was it just more people Because if you added 44,000 jobs net, I would imagine that more people are coming to the labor market.
Well, I mean, one thing that I'm looking at, and we're going to kind of get into this when we talk about inflation, but I do wonder how accurate that was. Because right now the government was shut down, so that is based off survey data. Well, if the survey data wasn't great, I mean, how accurate is that number? So we'll have to see kind of, I think, as time progresses, what the next unemployment rate is, and then I think that'll give us a better idea of where we're at. And, you know, when we look at all of these numbers that are coming, I mean, you definitely can't deny that the labor market is slowing. A lot of people have coined this a no hire, no fire labor market, you know? Which I kind of, it's interesting, right? It's like, well, I mean, we keep saying it's okay. And I think that's exactly what a no hire, no fire market is. And it leads me to say I'm just not overly concerned about the labor market. I do think there are some question marks. And you have seen, you know, declines in the payroll level in 3 of the last 6 months. So that is concerning. But we are still seeing these large declines in the government sector as a whole, for the most part, be picked up in the private sector, regardless of healthcare, government adjacent, you know, kind of space, or other areas like construction. I think largely probably from these data centers and this AI build out. But I still think this labor market is okay.
Yeah. Well, I mean, that can take us to the next one, which is inflation report shows great progress. Can it be trusted? And this is the thing, like I asked about, well, was there more people coming into the job market? That data may have not come out because they didn't get it. They may have not had time to do it, or like they lost. I mean, it was such a big task to do this. They're off kilter. So, but can it be trusted? Well, let's talk about the inflation report, because headline November CPI came in at 2.7% compared to last November, which was well below the estimate of 3.1%. And core CPI, which excludes food and energy, showed an increase of just 2.6%. This was the lowest reading for core CPI since March 2021, when the increase was just 1.6%. And it also came well below the estimate of 3%. So we're getting some good numbers here, maybe.
Yeah, and you know, there are, again, going to be good numbers in areas, but also there are some troubling spots or areas that did remain challenging, especially in food. And I was kind of surprised by this. I pulled out this one. It was one of the top increases. It's uncooked beef roast.
Wait. That is such a small area. Uncooked beef roast?
Uncooked beef roast, yes.
Wow.
And it's kind of a microcosm for beef as a whole, but I mean, uncooked beef roast, they climbed 21.2% year over year. Beef as a whole has been really challenged, and I'll get into that in a second, but coffee also was a large increase of 18.8% year over year. But talking about beef prices, they've really struggled. I did not know this. I know it was a challenging area, but cattle supply actually touched its lowest point in 2025 since the early 1950s.
Wow.
And you also have to compare to that, we are a larger population now. So, I mean, I bet you even as a percentage, that cattle supply really has to be at troubling levels. And if you look at coffee, I mean, coffee prices have been hit extremely hard by, you know, extreme weather in major coffee producing countries, as well as the tariffs that were levied on Brazil. You know, I generally drink just coffee in the office here, so I don't really go out and get a cup of coffee, but I'd have to assume those prices have gone up for your, you know, maybe a $5 latte is now a $7 latte.
Should we start charging for a coffee in the office here?
I don't know. What do you think, Michelle? Yeah.
I don't think the employees are like that. But, you know, I was looking at that beef. Does that include hamburger, you think? Is it all
beef prices.
Beef?
Yeah,
Beef
I mean,
prices?
because the cattle is just so limited right now that I think the margins that they have to extract are so tight that they have to increase prices.
And I do remember reading, I'm going to say months ago, that they are having trouble, I believe, in the Midwest because of lack of water, that they can't grow the grain for the cows to eat, and that is hurting the supply of cows. Another thing could be the demand may be lower, because I know there was also a trend where people were stop eating meat and eating more chicken and fish. Oh, and how did that Beyond Meat do? Did that do pretty good? That didn't replace anything? It doesn't help at all. So, let's see where we are there. So shelter inflation was another positive in the report, as the annual increase was just 3%, and it's believed there is more relief coming for the largest weight in the CPI. And we've talked about that for a long time as well, which is, well, the CPI generally The shelter index costs, well, about 1/3 of the headline number. If the inflation for shelter slows further, it would be very beneficial for the inflation rate as we progress through 2026. And we've talked about this as well. We saw this happening. It had to happen because of it's based on the rent equivalent, I believe is the correct terminology they use.
That's part of it.
Part
yeah,
of it.
They do use actual rents, and then for homeowners, they use the owner's equivalent rent, which is just survey data.
Right. And we talk about constantly. I talk to people across the country as well. They go, yeah, there's a lot of apartments here going up as well. So this always happens. I've been doing this for over 40 years. It always happens. There's a big need for something. You get all these builders and everything. They come in, but they got to get the permits and everything else. And then by the time it hits the market, oh, we got too much of it now.
Yeah, and I'm still shocked, honestly. It's taken this long for the data to come through on CPI. But what I think that does do is it leaves a longer run rate for shelter being less problematic in the CPI report. Because now we've kind of seen, well, it took a while for rising prices to hit shelter. Now it's taken a while for the leveling off in prices essentially to be a positive in the CPI. So again, if we have now a inflection and prices go back up in real estate, well, now we should have a longer run rate for it to flow through to CPI again, which begs the question, how impactful is CPI? And, Stephen Mirren, who's the most recent appointee to the Fed, I was actually listening to him talk on CNBC, and he was saying, look, I keep voting for these big rate cuts because I believe that shelter inflation is going to be so small next year that is going to be a huge benefit to CPI, and I think we are going to be seeing close to the 2% target.
So he's kind of seeing deep in the numbers saying, yes, we can cut rates because while you'll see unemployment, you see inflation around, we'll say 2.6 to 3, nowhere near the 2%. He's saying this shelter index, shelter inflation, will be coming down. So he's foreseeing a year from now. And that's very insightful.
Yeah, it was interesting because I've been really skeptical of the large decreases that he's been advocating for. But, I mean, what he was saying did make some sense. And I still think I disagree with the fact that he wants rates even like substantially lower. I think that could cause issues. But, I think you get the Fed funds rate around that 3% level. I think he wants it around 2 or something like. I think Trump wants it under 1, which I think that would be inflationary and problematic. But I think if you got it around that 2.5%, 3% level, I couldn't see the need for more rate cuts beyond that. I think that's where I'm having a hard time conceptualizing that. But the idea of inflation coming down, that does make sense.
Yeah, and actually Washington, as we know, they want the lowest. They want a boom economy, which we should have starting because of all this foreign money coming in to build and stuff. That should start next year. That should help. But I feel you're right on the 3% because you want to have something left in the gun, some bullets left in the gun. Because what if things don't go well? Yeah. And now you're at 1%, you got nothing left to do.
Got nothing left to do. Negative rates, I don't think negative rates would be a good solution. Or, also it could stoke further inflation, which would be a problem. And I think you do have to have a hurdle rate when you borrow money. You can't have free money forever. Right. That just leads to huge asset price inflation. And I think it could cause bubbles down the road even further than where we're at. And the last thing I was going to say about the CPI, I kind of mentioned this, but again, the exact data was there was no CPI for October because, well, they couldn't collect the survey since the government was shut down. And the BLS was only able to collect about for half the month of November. The shutdown did not end until November 12th. And I was reading some other things from economists, and they were saying, think about that as well. So what happened in the back part of November? You had Black Friday, you had Cyber Monday, all the Thanksgiving deals. So you put a larger weight on a lot of the goods that were sold during discounted times. So it could have actually even made that CPI look even stronger. So, I mean, there are a lot of question marks around it. I don't just want to throw out that data, but I think that December report, which will be due sometime in January, I think there'll be a lot of weight on that since that'll be the first full month of data. I think that we'll get in surveys for employment and also inflation.
Right. Well, sure. You want to talk about, you want to become a millionaire? Invest in your 401k?
Sure thing.
All right. There are more and more people with $1 million or more in their 401k as companies like Fidelity and Vanguard are seeing record numbers of people and accounts of more than $1 million. Now, Fidelity said they hit the highest level ever when it comes to 401k millionaires with about, I'm surprised, that's 3.2% of their 401ks, about 654,000 accounts are now over $1 million. Vanguard has similar numbers for the 401k millionaires as well.
And we always talk about how great the 401k is. And the thing you have to understand is it's just not a get-rich-quick scheme. If you look at it, it's a proven way to build your wealth long term with proper investment choices. It is estimated that roughly 86% of those with $1 million plus in their 401ks are 50 or older. So, again, it is a great tool for building those retirement assets, but it takes time. It is also estimated that around 1,000 people per day become 401k millionaires in the U.S. The key to becoming that 401k millionaire is to invest wisely, which means not too aggressive, but also too not too conservative. We see that far too often. I got all these bonds in there. I got all this cash in there because I'm nervous. That's not going to be successful for you long term either.
Yeah, it's understanding, as you said, invest wisely. Also, when a portfolio drops, you cannot sell everything and wait for the market to get better. You, an investment professional, must verify that you have good quality investments in your portfolio that can handle the financial storms. And also, it's important to continue adding to your portfolio during these difficult times, because that's people do that. Like, oh, they panic, they pull out. Well, I'm not going to put anything in my 401k. I'll put it in the money market. Like, no, if you're doing it properly, as we always say, you're investing in good quality businesses long term. Don't worry about a 6 month or 1 year, even a 2 year pullback. I mean, you're buying things on sale.
Yeah, I was going to say, you know what that's called? It's called buying low.
Yes.
That's what you want to do when you invest. And when it comes as well to investing in that 401k, it's important not to pull money out from that plan. No matter how bad you think the situation is, it'll improve many times. And it is much better to deal with problems when you're young rather than when you're in your 60s, because you did not let your 401k grow to that $1 million or over that $1 million mark. And unfortunately, we see this, we've seen it in the past where people, they want to retire and they just can't.
Yeah.
And it's like, oh, well, you know, I took out 401k loans 10 times along the way. It's like, well, no wonder you don't have any money in the plan. You've continuously been borrowing against your retirement, which, you know, it sounds good in the moment, but gosh, it can really hurt you in those later years.
And the other thing too, I mean, the 401k millionaires, it's not people like super wealthy. It's your average person that, you know, was maybe a plumber, maybe, you know, worked as a teacher or whatever, and just put away the right amount of the 401k, invested it wisely, in over 30, 40 years. Like, wow, I got $1 million in my 401k.
I've made the claim before. If you buy a house, you don't do anything crazy, you have a normal mortgage on it, and you do your 401k, put away 10%, and you get the match, frankly, there's really no way you can fail.
No.
Like, as long as you don't borrow against it, you don't do crazy investments. I mean, we've seen this before where we have clients, they own their home and they have $3 million in a retirement asset. They weren't making $2 million a year when they were working. I mean, they were just a normal wage job, but they did the right things along the way.
Right. And I think you said to the before the show, the average match is what, 4 points?
4 to 6%.
4 to 6%, yeah. And that really adds too, because if you save 10%, you'll do very well. You add that match, now you're at 14, 15% you're putting away. That's how you get to where you want to be. And if you want, you can maybe retire at 60. You don't have to wait to 65 because you did it right. The sooner you start, the better.
Yeah. I mean, I've seen some people, it's like, gosh, you could retire at 55 because you did the right things along the way.
Yeah. Well, let's talk about this surprise on China's trade surplus, where it hit $1 trillion this year. That was a surprise and not what we were looking for. The United States purchased around $450 billion of manufactured goods from China in 2024, but trade has dropped between the two countries. So how did China come up with a surplus of $1.1 trillion through November 2025 when the United States stopped buying so much? Well, the current tariff on goods imported from China is around 37%, according to the Tax Policy Center. And imported goods from China, well, as I said, they're dropping dramatically.
Yeah, and when you look at it, obviously, U.S. down. Well, this means China had to increase in other areas, and they have been able to do that. They've been able to do this and more than compensate for the loss of exports to the U.S., which are down roughly 19%. So, again, you talked about the decline, but the decline is substantial. 19% decline from your largest customer. That's generally going to be hard on business. But China has seen an increase of exports to Southeast Asia, 14%. I do wonder how much of that is exported to Southeast Asia and then exported to the U.S. So that's a big question mark. And also to the EU, the European Union, they've increased 8%. Latin America saw a 7% increase. And then a big increase here. I was kind of surprised by this. I wonder how small that base was initially, though. But a 25% increase in exports to Africa. I mean, that's a large increase. But if it was off a smaller number, maybe not as impressive.
Yeah, and I'm not sure how many people are in Africa, but I know that China is doing more and more in Africa, building, doing more loans. They're really becoming part of Africa to really help them out. So I don't think it's a super big number, but I think that number is growing, and I saw that too, like 25%. Wow, that's pretty big.
Yeah, I mean, there's obviously some places in Africa that are more developed, like South Africa, and then I think up in like Egypt and kind of along that Mediterranean Sea. I think there is going to be a little bit more development. Obviously, there's other areas in Africa that are still more tribal, but I don't know where China's business is going essentially there, but it's going somewhere.
It is going somewhere. And even though they're turning out more cars, manufacturing products, and chemicals than ever before, it has created some very heavy competition in China, which is pushing down prices, profits, and income for the Chinese manufacturing companies. I mean, this was surprising that that's why you talk about sales are nice, but you got to have those profits. And China did have a $1.1 trillion so far in trade surplus, but there's a cost to them because the competition, their profits aren't there as good.
Yeah, and I think oftentimes China, they just build, and sometimes it's like, well, you weren't very profitable. I mean, you talk about the ghost cities that kind of were developed in China, and now it's like you have these ghost exports almost where they're doing all this manufacturing, it's going out, but at what cost?
Right.
And I don't know what China's long-term plan is, but that is the thing oftentimes is China is very long-term thinking. I think many times they don't care about the profits today. They care more about taking over the world essentially. And while it's like, yeah, we're not making money today, but we're going to keep stealing market share, which that can be concerning in the long run.
And you said, take over the world. I remember Pinky and the Brain. Going to take over the world today. And that's what China planned. I guess that was Pinky who was the one that wanted to take over the world.
I don't remember.
Yeah. It was the Brain. It was the Brain, obviously. He was the Brain. So that's China. So.
The other thing we do look at here is when you talk about the trade talks, there won't be another round of talks between the U.S. and China. Obviously, until next year, we are winding down 2025 and entering 2026 pretty quickly. But at the last set of trade talks, the U.S. did lower our tariffs, and China promised to buy American soybeans and end a plan to tighten the export of rare earths, which are critical and found in many products from jet engines to cars and many other electronics as well. We will continue to follow the developments of these trade talks as there should be more news coming next year. And we did talk about the situation with soybeans. Very interesting numbers there in the newsletter. But I do wonder if China is, again, going to actually fulfill that commitment.
Speaking of the newsletter, it goes out every Friday at 5 o'clock. It is free. If you want to get that newsletter, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Other topics as well, where farmers will be receiving $12 billion to help with their difficulties this year. Check out the new high-tech company, Walmart. Yeah, Walmart. The big electric vehicle boom that, never happened. And the number of billionaires around the world continues to grow. And risk on Wall Street is rising as prediction markets become more available. All this information at our website, smartinvesting2000.com. Again, smartinvesting2000.com. That is on the newsletter. It goes out every Friday. All right, let's move on. Talk about a company here. Talking about Oxford Industries. And I just think of shoes, but it's not. You said this is Tommy Bahama and some company, Pink Lily or something?
Lily Pulitzer.
Okay.
And that's how I'm going to pronounce it. The other funny thing I always forget about, have you ever eaten at a Tommy Bahama restaurant?
I do. I like that, yeah.
Yeah, it is actually, it looks like it's owned and operated by Oxford Industries.
Oh, really?
I wonder how many they do have around the country. But
I know we go to the one in Fashion Valley, and it's just great. You do your shopping, and it's kind of like a sidewalk cafe, It's cool.
I think I went to the one in Palm Desert, but that's the only one I've been to.
Okay. Well, let's look at the numbers before we run out of time. Whoa. Well, I say because I just realized they're in the industry of apparel manufacturing. The short on this is 23.9%. There's something going on with this company that's not good. We do not see any earnings, no PE ratio. The industry is at 22.6. Price of sales looks inexpensive at 0.4 versus 1.3. Price of book value looks good, 1 versus 3.3. And price of cash flow also looking good, 3.4 versus 12.3. And the PEG ratio, 0.8 versus 9.9. So some good things here, but I'm worried about the lack of earnings. Also, too, we see over the last 5 years, no earnings growth for the company. Industry is up 20.3% for the 1 year. Also, too, sales down 2.4% year over year. The industry up 10.5%. Now, the analysts do give Oxford, I'm going to say Tommy Bahama, a good 5-year growth rate of 16.6%, almost 4 times the industry at 4.2%. Wow, they do pay a dividend here, and this is shocking. 7.6% payout ratio is nothing there because they're losing money. So you got to be cautious on trying to get that 7.6. That dividend could be cut. I'm going to say probably likely will be cut. The payout ratio on free cash flow is about 164%. We do see on the balance sheet, let's take a look at that. Current ratio 1.3 versus 1.8. That's okay. Debt to equity 1.1. That's the same as the industry, so I'm okay with that. Look at the net profits margin. Again, minus 0.2%. So they're not making a profit after everything they do. And those shirts, I know, they're not cheap. They get quite a bit for them. The industry is at 5.8. Return on equity also a negative 0.5%. Industry at 24. Free cash flow is only 26. I believe that's $1 million versus $767 million for the industry. I hope we got some good news going forward because I was hoping I could buy this and because I spend so much money buying those shirts.
Well, looking at Oxford Industries again, their ticker symbol is OXM. It's $36.32 is that current price, 52-week range. Wow, the low, $30.57. And I say wow because the high, $89.86. Year to date, the stock is down over 50%. Looking over the last 1 year, down 55, 5 years down 41%, 10 years down 42%. So, I mean, this has not been a good performer. And I was kind of blown away by this, the market cap on this business, $552 million.
Why are you blown away by that? Thought it'd be higher?
I thought it'd be higher. I mean, Tommy Bahama is a pretty well-known brand. I mean, I thought it'd be at least $1 billion.
That's a retailer.
I mean, it was
specialty retailer.
Yeah, I mean, it was over $1 billion, but the stock's come down so much. But, you know, you look forward for Tommy Bahama. You go out to January 2027. I'm going to say it's not bad news here. Estimated earnings per share is $2.66. It does give you a target sell price of $44.16. Does trade just around about 14 times those future earnings. And I do wonder how impactful tariffs have been on this business because this year, its estimated earnings will fall 66%. So I'm wondering, you know, is that a function of the tariffs? Because sales are only estimated to be down about 2%. So that had to be a cost of goods issue rather than a massive sales decline.
Yeah, my wonder was, you know, how much is from China? Because that's been a big thing that's really hurt a lot of them. And also to see the range of the estimate of 266, a low of 192, a high of 306, and also 90 days ago, the estimate was $3.60. So that tells me maybe it's not tariff related because the tariff's been around since what, April? Yeah. So something's happened over the last. That's a decline of $1. That's a third.
Well, they did come out. They had weak guidance in the most recent quarter. It caused the stock to fall 22% after reporting earnings. They're looking for guidance this full year to be $2.20 to $2.40. Analysts were looking for $2.90. So that's why the expectations have come down so much.
Maybe the shirts are on sale. I'm going to run to them all and get one. All right. When we come back, we're going to talk about Exxon, Vail Resorts, and Costco. Stay with us. You're listening to Smart Investing Show with Brent and Chase. All righty, welcome back to the Smart Investing Show, and this is where we kick up the second half with financial planning. And for that, we are joined by Harrison Johnson, a CFP with Wilsey Asset Management. Harrison, glad you're here.
Good to be here, always.
And I think when you're done, people are going to say, I'm glad I heard that because you're talking about taking advantage of itemized deductions before December 31st. You realize there's only, 11 days left? How many days left?
Well, I know. Christmas is a week, next week.
Well, today is the 20th. So you got, about 11 days.
Yeah. So there's still time. So that's why we're talking about it today. So this year with the tax law that passed earlier in July, itemized deductions are going to be changing. There's still people out there that are not going to be able to itemize because the standard deduction is large and it got increased as well. But since there's the repeal of the $10,000 SALT deduction limit, which applies to state income taxes and property taxes, more people, especially in places like California, are going to be able to itemize. And so individuals are cash basis taxpayers, so they are able to deduct things that they pay when they spend the money as opposed to when it's actually due. So for example, property taxes are due December and April for this fiscal year. However, if you make that April payment before the end of the year, that means you can deduct it this year on your taxes. State income taxes is another one. So if you make estimated tax payments, the fourth state tax payment is due January 15th. But if you make it before the end of the year, that means you can deduct it this year with the other deductions. Another thing is if you are, on payroll and you have taxes withheld from your paycheck, you can increase your withholdings if you need to. And any withholdings that are withheld from your paycheck are deductible this year as opposed to next year. Another thing with your mortgage interest, mortgage payments are due on the 1st of the month. And then as long as you pay it by the 15th of the month or the 16th of the month, there's no interest or problems with that. So this next January payment due January 1st, if you make it before the end of the year, the interest that's associated with that payment will then be deductible this year. So it's a way to take expenses that really aren't due until next year, pay them this year, and then that might allow you to itemize because now you have enough deductions to get above the standard deduction. Or if you are already able to itemize, this increases that deduction and accelerates that tax savings 1 year sooner.
Now, don't you want to think about your situation for income? Because say you have really low income this year and high income next year, do you want to do this? Or
then
no?
you might want to defer it. So that's a
yeah.
very good point. You have to look at what tax bracket are you in this year, what tax bracket are you in next year. If you're in the same tax bracket, then it probably makes sense to accelerate it. Dollars today are more valuable than dollars tomorrow or next year in that case. So you're better off making those payments and getting the tax payment sooner. But you're right. If you expect income to be higher next year, for example, then maybe what you would want to do is defer those payments to next year, and then the payments that you have next year, accelerate those ones, 12 months from now and pay those at the end of next year. And that way you're kind of clumping all of those deductions into 2026. So yeah, you want to look at what brackets you're in and kind of where you can make payments to get that deduction. Charitable deductions is another one. Next year in 2026, there's a change to how much you're able to deduct when you make itemized charitable donations. So that's something where you might want to make extra donations this year, if that's something that you do, because they're more valuable this year because they're not subject to AGI limit next year.
Right.
And I almost think this is really helpful for somebody maybe that's like retiring
is
next
a
year.
big
that
part
could
of
be
it, yeah.
a huge benefit.
Yeah, if you had a lot of W-2 income this year, maybe you got severance pay or something because you retired this year and your income is high, and next year it's going to be lower because you're on Social Security and you're choosing how much of your retirement accounts you're able to withdraw or you want to draw, and you're going to be in a lower tax bracket. This might be, your last high tax year before you go into low taxes. And so if you can accelerate some of those deductions, write them off this year, could save you a few $1,000s since they're not going to be worth as much next year.
Another concern too, and I know it's going to happen. You say, Brent, you probably don't qualify. Income levels. You said there's no more SALT limits. So what about the income?
So good that
limits?
you bring it up, because right now it used to be $10,000. Right now,
But I'm talking about the income that you receive, your yearly income.
Yes, your income determines how much of this you can deduct.
Right.
So the limit was 10,000. Now it's as high as 40,000, but that has an AGI phase out between $500,000 and $600,000. So if your income is less than $500,000, then you can deduct up to $40,000 of state income and property taxes. So that's another thing to keep an eye on, is if you're under that income level, but if you've already paid state income taxes and property taxes that are $40,000, then making extra payments this year won't help you because you can only deduct $40,000 of those. But to your point, Brent, at $500,000 or below, up to $40,000, and then as your income exceeds 500 and goes up to 600,000, that $40,000 cap then phases down to $10,000.
Phases out.
Yes.
Phases down.
Phases
and
down.
Phases out.
Yeah.
No, that's all I got. I mean, just love taxes.
Well, I hate them personally. So
Oh, I did too. And it's so important you bring this up because, people they hear just part of it. Oh, great, I'm going to, accelerate my deductions. And all of a sudden, your income's $700,000. Sorry, you got nothing.
Didn't do anything. Yeah.
Didn't do anything.
Yeah.
Another reason why I've kind of been having this conversation with people lately is, maybe this was a year where you had extra capital gains. And so those capital gains are triggering net investment income tax, or, if their income's really high, maybe that's triggering, pushing you into a higher capital gain tax bracket. So you want extra deductions. So maybe it's not ordinary income that you're worried about. Maybe it's other investment income. So making, these payments in December as opposed to January or April or whatever it is, gets those deductions sooner, and then it offsets maybe some of that higher investment income you might have had because the stock market's been doing pretty
So
well.
that could help with like IRMA and everything
IRMA
else
too, yeah. doesn't help with IRMA now that I think about it, because this is an itemized deduction. Itemized deductions reduce taxable income. IRMA is based on adjusted gross, so that's based on the total. So it purely influences your federal income tax liability. But, if you're in a higher tax bracket, people are always looking for extra deductions. So,
And I got a quick question. I mean, you're a fee-based planner. You take care of the stuff for people that can call you up and you say, yes, you can do this, you can't do that. Because I think some people, their immediate response is, I'm going to call my CPA. But if they've got a good fee-based financial planner, call you first.
I mean, this is stuff that I'm always trying to be proactive. Some CPAs are probably also looking at this type of thing, but other ones might be, you might not be talking to them until April when you pay your taxes. And so, but at that point, it's too late because this is something that you want to do before the end of the year. So, with your CPA, you might be talking to them February, March, April as you get your 1099s and your W-2s and everything. But if you can have this type of conversation, we could pretty quickly look at what your income looks like, what things you should or should not do. If, it's the end of the year and you're also taking required distributions or doing Roth conversions, what is that tax impact going to be? Do you want to have extra tax withholdings on that? Like if you're doing an IRA withdrawal because you have to take an RMD, maybe we want to have a larger amount of that withdrawal withheld for state taxes, because that means that on your 1099, that's going to show state withholdings that are deductible when you file your taxes. So all of those things, we look at, and you need to have it done before the end of the year.
And I point this out because I want people to understand the difference between a fee-based planner like yourself and somebody that calls themselves a financial planner and turn around and sells you life insurance, annuity, or mutual funds, whatever it may be. I mean, a true fee-based financial planner knows the tax situation. These other guys that are, I'm going to say salespeople, they're not even going to address this. They don't even know what you're talking about.
Yeah. I mean, I don't have to sell anything because there's so much to know about with this type of stuff, and there's so much value that can be added by understanding this. I like learning about it. A lot of people don't, but I think it's interesting. So,
well, we like numbers. I mean, we're a weird group because we like numbers, we like finance, you like the taxes, and it's like that's why we have a lot of clients, because they like coming and talk to us. So, Harrison, thank you very much. We appreciate the time, and you have a good day.
Thanks, guys.
All righty. Again, that's Harrison Johnson. He's a CFP. If you want to contact him, you have questions about a financial plan, you have questions about your taxes, maybe the guy you're talking to or woman you're talking to is not getting back to you, gives you no help at all, give him a call at the office. Harrison, give him a call at the office, 858-224-0004. Again, that's 858-224-0004 for that free consultation. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com, and just send Harrison an email. All right, Chase, you ready to do, I think we're doing ExxonMobil.
Yeah, it's kind of funny because you had OXM for Oxford, now we have XOM for Exxon.
Yes, it's just a switching of the O and the X there. Makes a big difference, though, doesn't it?
Yes.
All right, let's take a look at ExxonMobil. Again, their symbol is XOM, in case you got confused on that. We do see there in the, I'll say, industry of oil and gas integrated, short is only 1.2%. Surprise on this, 67% institutional owned. A lot of people own this stock individually. Which
I think it's the dividend, a lot of retail investors like that big Exxon name.
Yep. Well, looking at the valuations here, we do see the PE ratio is kind of high. It's 17 versus 13.6. Price of sales 1.6 versus 0.7. Price of book value for Exxon is 1.9 versus 1.2. And even the price of cash flow for Exxon is 9.8 versus 5. Now, they do have a PEG ratio, which is price earnings divided by growth, which tells you how much you're paying for the future growth here. It's only 0.9 versus 2.7, so that is a positive. Now, unfortunately, year over year, the earnings are down 14.3%. The industry is down 13.6%. The sales were down 4.4%, but the industry was down 7.7%. Now, I love this because we know, like, oil's going to keep dropping and dropping. Not forever. This is going to change, and you'll see more oil produced. But the 5-year earnings per share growth rate is 19.6% for Exxon versus 18.7% for the industry. So that's a positive. You get a decent dividend, about 3.5%. They use 58% of their earnings to pay that out. Looking at the balance sheet, we got a current ratio of 1.1 versus 1.2. That's good. Wow, debt to equity is only 0.2 versus 0.4. So a low debt company. That's always nice when you have a company paying a dividend. You know they don't have to pay a lot of debt, interest on that debt, and so forth. We do see a net profit margin of 9.2 versus 5.3. Return on equity is 11.5 versus 9.9. Ooh, love this number. Free cash flow, $23.8 billion. Yeah, that's got to be billion versus 15.6 billion for the industry. So they're bringing a lot of cash. That tells you that that dividend is probably pretty strong. I'm not sure the history of raising that dividend, but I bet you they probably raise that dividend on a regular basis as well.
Yeah, I'd have to assume so. I mean, they've been paying that for a long time, so I assume they've increased it too. Looking at the current price here for ExxonMobil, their ticker symbol again, XOM, it's $116.69, 52-week range. The low here, $97.80, and the high, $120.81. Year to date, the stock's done okay. It's up about 8%, not including the dividend. So probably with the dividend up around 12-ish%, I'll call it.
What's that time frame for?
Year to date.
Oh, year to date. Okay.
Yeah. Looking forward, though, for the company, I got to December 2026. Estimated earnings per share will $7.19. Gives us a target sell price here of $119.35. So right around that current level. The big thing with this company, though, is the range of analyst estimates is huge. The low here, $5.91, and the high, $10.91. And I think the difficulty with this company is obviously the question mark around oil. Oil this past week actually hit its lowest level since 2021 when WTI fell under $55 a barrel.
And now we've talked to, like, there's a possibility that could fall below 50, which causes a short-term problem because then probably Exxon will fall and so forth. But what that does is that it increases the demand, except for in California. Gas prices will fall. I say except for California. They do, but it's just so crazy in California.
Well, I got this for you here, right? So U.S. gas prices have fallen below $3 per gallon to the lowest level in 4 years. I feel like we don't notice that here in California.
I think I saw 405 at an independent station on Poway Road the other day. But yeah, I mean, it's just crazy. But what that does, if it keeps falling, now it's kind of tough on the oil companies, the producers in the short term because their profit margins shrink. But then people say, well, gosh, I'm not going to buy an EV. I'll buy, and I'm not going to buy a little tiny car. I'm going to buy an SUV. I'm going to buy something that they don't care about the gas mileage so much. Then what happens, they're producing more oil. Yes, lower profit margin, but selling more of it. And they'll make more money in the longer term.
Yeah, and I think it is something that should reverse course naturally. I mean,
Right.
You have OPEC that wants to make money off of this. The big reason I think oil has really struggled, well, on the other side of it, you have the issues with Venezuela that are kind of circling about. That might actually put upward pressure on the price of oil if, there is a further escalation between Trump and Venezuela.
And aren't we're
Kind of sanctioning them.
sanctioning them, and haven't we taken some oil tankers too?
Mm-hmm. Yeah.
I wonder where that oil goes.
I don't know.
Yeah.
Yeah. Well, this is kind of interesting, right? The reason that I think oil has been pressured, or part of the reason, is number one, OPEC Plus has really been pumping. And also, two, there is maybe a potential solution circling around between Russia and Ukraine.
Mm-hmm.
And if that does come to fruition, well, then Russia would come back to the market, which then would beg the question, now would OPEC pump more to try and take market share and keep their market share in place? That could create an even larger glut of oil. And I was kind of surprised by this, but Russian oil stored on water is currently estimated at around 170 million barrels.
Oh, wow.
So, I mean, that would then come back online as well. So there is this potential supply glut around the corner that, as you said, maybe pushes oil below $50 a barrel. But I'm almost wondering, there's a saying, buy the rumor, sell the news.
Yeah.
I almost wonder if it's now sell the rumor, buy the news, right? Like, because if it comes to fruition, I wonder if, things are already so bad in the oil market that if oil is like, okay, well, now there's nothing else that bad that could happen, and oil does turn around and go higher after that. Because I do think that oil long term is not going to be at $50 a barrel.
No, I think it will be higher because demand will increase. And you got in the newsletter the big electric vehicle boom. You got to read that because EVs are not taking much market share on the oil side. And I think oil will be around for more years to come. But on the Russia thing, I know Russia is kind of selling some of their oil through the back door.
To China?
Yes.
In India?
Yeah. So how much of that is hitting the market, as well? But you said 170 million barrels is in.
Yeah, I had
just
never
like
seen
floating
that
on the
number.
water.
Yeah,
Wow.
but that'd be a lot to come back online. And, when I look at this in the grand scheme of things, like I don't think I'd buy a buyer obviously now of Exxon at these levels.
Right.
But if you go out to December 2027, we'd have to wait for the earnings report to come in after this year end. So sometime in January, we'd probably get that number, maybe early February, depending on when Exxon reports. But 2027 estimated earnings per share is about 8.6 for forward PE is under 13.5. So you get a pullback, maybe earnings coming a little bit better. I mean, you could have Exxon slip into a potential valuation that would enable us to buy it. And I do think looking at oil companies when oil is around $50 a barrel is likely a prudent move, because I think oil will turn around and go higher.
Yeah, and I think you want to buy it when I think Exxon's definitely worth watching. But you want to buy it when there's blood in the streets and, oh my gosh, oil's down low, $50 a barrel. Oh, it's terrible. That's when you say, ExxonMobil is now at, I don't know, 20%.
And we rely on the analysts many times, but sometimes I'm going to say it's not always the best solution. I say that because when oil is low, like $50 a barrel, their estimates aren't accounting for the fact that oil could go back to $75 a barrel. So then all of a sudden oil moves back up and those estimates are way too low. When oil's at $100 a barrel, it's like, yeah, they're going to make tons of money. And then it comes back down, and it's like, well, your estimates were way overvalued.
And that's why you looked at the range, because when you have the range so far out of whack, or such a large range of almost double, I think it was, that's when it's like, wait a minute, there's some problems here with this estimate. Some analysts are getting it right, and some are just like not getting it right.
The guy that's at $5.91 for 2026, I think, is estimating that oil will be at $50 the whole year.
Yeah. So, again, I think we're going to say it's a watch, not a buy yet, but I think you could have some opportunities of that down the road.
Maybe early 2026, there could be some opportunity there.
Well, let's look at something that we've not looked at. A company called Vail Resorts. They're in the resort and casinos industry. I love their symbol here, MTN for mountain. I think they're mostly known for Vail. I think they're expanded over the time, but for skiing is what they're kind of known for. Another company with a high short on the float, 16.4%. That's not good. They do have a PE of 22.1. The industry, nothing there at all. Price of sales, 1.9 versus 1.4. Price to book value, very expensive, 35.2 versus 2.8. I'd imagine they have a lot of real estate in their portfolio, but I could be wrong on that. Price of cash flow, 9.6 versus 7.6. PEG ratio, 2.5. That's okay. The industry's up 4.8. We do see earnings are up 14.7%, which is not bad, but not as good as the industry, up 27.5. And sales for Vail Resorts was up 3.1% of last year, just below the industry at 4.9. They get a 5-year growth rate on their earnings from the analysts of only 3%. The industry's up 8.4%, so that's not good for Vail Resorts. Dividend, nice dividend here, 5.8%, but they use 127% of their earnings to pay that out, and the free cash flow amount for the payout ratio, 93%. That's pretty high. Kind of warning, you could see a cut in that dividend down the road here if things don't improve quickly for them. I think they probably need a lot of snow this year is what they probably need to get up their sales. Look at the balance sheet. Not a good thing here. Current ratio 0.5 versus 1.3. That's a little bit low. That worries me on the liquidity side. Debt to equity 21.9 versus 6.2. Those two things combined kind of says maybe there's something else going on with Vail Resorts that, we talk about the franchises, different things here. So that's just such a strange number. You got to understand that before you invest in this company. Net profit margin 9% versus 5.5. Return on equity, wow, 170.3%. I'm telling you, that probably means a very low equity. And then free cash flow is 352 versus $780 million there. I'm hoping you got something better going forward, because so far the only thing I like is a dividend, which could be cut.
Well, the interesting thing is I'm surprised this company is not a REIT. It looks like it's just a normal company. I mean, we're not looking at FFO.
Did you see if there was a lot of real estate in it?
It operates in 3 segments: mountain, lodging, and real estate.
Oh.
So, I don't think I'd step in and buy something like this because it wouldn't necessarily fit our rules.
Right.
But you could almost justify that maybe those earnings are lower than they should be if there's a lot of depreciation. Maybe their cash flow is much stronger than they should be. Because when I look at this, I mean, you're right, it's not in Vail, Colorado anymore. I was blown away by this. I mean, They're in Europe, they're in Australia, they're in Canada. They have, resorts all across the country in, the United States as well. I mean, you're in California, you're in Utah, you're in, it looks like even back east, you're in many different places. I was kind of surprised. I thought they would be really concentrated in Colorado, but they have resorts all across the country and the world.
Yeah. Wow.
But looking at the numbers, it's $153.53 is the current price for Vail at their ticker symbol MTN for Mountain. 52-week range, though. The low, $129.85. The high, $191.85. Year-to-date, the stock is down almost 20%. But this is kind of what I'm talking about. The earnings still don't look that great. You out to July 2027, estimated earnings per share here, $7.94. Gives you a target sell price of just $131.80. But I mean, if they have a ton of depreciation, that's really gonna, exacerbate the earnings versus the cash flow. And we generally buy our companies based off earnings, not cash flow, unless they're a REIT. But I'm surprised they don't function as a REIT.
And I did look at the equity, because why it's so low. It's $156 million now. Just 3 years ago, it was $1.3 billion. The liabilities are up about $600 million there. So I agree with this. Kind of misplaced. It's hard to value this company.
Unless what they did was they sold off a lot of their real estate and now are focusing more on the operation. So like if you're a casino company, right, like MGM, well, they sold off their real estate. Now they're focusing on the operations. Maybe Vail did something similar, and maybe that's why they're a company, not a REIT. But been kind of surprising, as I'm sure a lot of that real estate would be quite valuable.
Yeah, interesting thing there to kind of look at. And that's why we spend time looking at. We tell people before you buy anything, it's 10, 15, 20 hours of research, because there's so much to kind of look at. We just try to point in the right direction here.
And I think, unfortunately, with Vail, I think it's an interesting story, but not worth the research, unfortunately.
No. Gosh, we're running out of time here. Quick here. We want to talk about Costco. And Costco, everybody loves Costco, and the stock has done very well, but it has not done well lately. So we're going to look at Costco to see if maybe now, after the big pullback, it was time to buy it. Costco, their symbol is COST. Discount stores is the industry, only 1.7% short on the float. We do see a PE ratio that, this is trailing 12 months, still high, 45.8 versus 36. Price to sales, 1.4 versus 1.2. Price to book value, 12.5 versus 8.7. Price to free cash flow price to cash flow is 25.8 versus 19.8. PEG ratio, not bad at 4.2, but the industry's at 53.5. I'd like to see the PEG ratio just a little bit lower than that. We do see that the earnings per share were up 9.7% of last year. Industry was down 2.5%. The industry, I don't think I said it's discount stores, so industry down 2.5. Sales up 8.3% for Costco, but the industry was up more. Industry was up 9.8%. 5-year growth rate on the earnings from the analyst, 10.5% versus 2.5%. The dividend on Costco, because the stock has gone up so much over the last few years, it's only 0.6%, but they only use 27% of the earnings to pay that out. Taking a look at the balance sheet, current ratio 1 versus 0.9, that is good. Glad to see they built this company with very little debt. It's only 0.3 versus 0.8. Net profit margin for Costco is 3% versus 3.1. Return on equity, very good, 27.4 versus 24.2. Disappointing on the free cash flow. It's good. It's $9 billion, but the industry is about $11.5 billion. So free cash flow is good, but it's not as good as the industry.
I'm guessing probably Walmart's got really good free cash flow and probably lifts up that industry average. But let's look at the current price here for Costco. Again, their ticker symbol COST, C-O-S-T, $855.62, 52-week range. I mean, definitely trading closer to the low of $844.06 instead of the high, which is $1,078.24. I mean, you talk about how well the stock has done. Over the last 10 years, it's up over 425%. But year to date, been lackluster, down about 6% so far this year.
Actually, with the dividends, it's 533%.
Wow. Yeah, I mean, it's been a great performer. But the problem is the valuation, as you mentioned. You go out to August 2027, estimated earnings per share here, $22.18. Gives you a target sell price of $368.19. So still trades for nearly 40 times earnings. And, I was reading these articles about kind of looking at value, and some people are saying Amazon's a value because it trades at like 22 times earnings. I forget the exact number. While Walmart and Costco are now trading at 40 times earnings. To me, it doesn't mean Amazon's a value. It just means, holy cow, Costco and Walmart are way overpriced.
Yep. And everybody loves Costco. And as an investor, please don't do this. Like, oh, it's done very well. The stock is up. I would never sell my Costco. Oh, don't do that. You're buying a business, and you bring up a good point. Why would you buy Costco at 40 times earnings when you get Amazon at 22 times earnings?
Amazon has better growth.
And more diversified. I mean, it's in my opinion, a much better company overall. I love Costco. I don't go there as much as I used to, but I think it's a great business model. But you never, ever want to overpay for a company. It just won't benefit you long term.
And I think this could be a great example of a stock that maybe doesn't crash, but just for like 5 years hardly moves.
Yep, goes maybe 700 to 1,000. Yeah. So, all right, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. And go to the website, smartinvesting2000.com. A lot of great educational information there. Again, smartinvesting2000.com. Thanks for listening. We'll be back next week right here on the Smart Investing Show.